In this last example, we're going to look at how we make changes to different accounts and sections of our balance sheet, income statement, and then the statement of cash flows. So as I said, we're not going to create a statement of cash flows yet. We're just going to be talking about changes to the statement of cash flows. So we're going to look at each one of these transactions individually. So first we have the owner invests $900 cash in business in exchange for stock. Okay, so on the balance sheet, we now have cash, which is an asset, and we have stock, which is an equity. So we increase $900. If I want to be able to text. We increased equity $900. So that is the effect on the balance sheet. This has no impact on the income statement, and for the statement of cash flows, it is considered a financing activity, how the company finances what it does. So these are the changes that that transaction would make to the financial statements. Okay. The next one is that we receive $700 cash for services provided. So we sold our services, we were paid cash. Cash is an asset. So in this, assets increased by $700. Okay. Income or revenues is also equity. So now our equity account increased by $700. So those are the impacts on the balance sheet. The impact on the income statement is that we received revenue. So this is a plus $700 increase to the income statement. Operating the statement of cash flows, we have three different activities. Operating activities, these are the things that happen daily within our business. Investing activities, and then financing activities. Okay, investing is where we as a company invest money in equipment and other things, and then financing is when we receive money to run the business. So selling services is part of operating activities, one of the daily activities that we do as a business. Okay. Now we're going to pay $500 cash for employee wages. So we've reduced our asset cash by $500. Now you remember, if something happens to total assets, it also has to happen to liabilities or equity in an effort to maintain that balance equation. Well, remember where the income and expenses ends up in equity and retained earnings. So this is an expense or a reduction in our retained earnings. It also ends up on our income statement as an expense, so minus $500. And it is an operating activity because it's one of the things that we have to do to operate our business on the statement of cash flows. So those are the effects to financial statements as part of that transaction. Okay. Now we're going to buy $100 of equipment on credit. Okay, so we purchased equipment. We've gained an asset. We have equipment, which is an asset. So we've increased our assets by $100. And because we bought that on credit, we owe people money. So we have increased our liabilities by $100. Okay. The next transaction is purchasing $200 or buying equipment for $300 cash. So in this transaction, we both increase and decrease our total assets. So cash is an asset. So we have negative $300 that we reduced in cash. And then we're going to also going to increase $300 because we increased equipment. Okay. Now we're going to pay $200 on that accounts payable. Okay. I'm actually going to change this one to purchase 200 in supplies on credit. Okay. So now we've increased an asset, supplies, and we've increased a liability. The main reason I changed that one is because we don't want to pay on accounts payable more than we owe. So we needed to owe more than $200 before we could pay back. Okay. Now we provide $400 in services on credit. So when we buy things on credit, we owe other people money. When we sell products and services on credit, other people owe us money. So now we've increased an asset, $400, because we have an accounts receivable. Someone owes us money. And we've increased equity. We received money, or we provided services, so that's part of our net income. That's also going to end up on the income statement. Okay. Next, we pay $50 in cash dividends. Okay. So we have 50. We reduced assets or cash by $50. We reduce our equity by $50 because dividends come out of equity. And that is a financing activity on the statement of cash flows. And then we collect $400 on accounts receivable. So this is $400 that we increased our cash because we received cash. And then we also have a reduction in $400 in cash because we reduced that accounts receivable. So now we receive the money for what people owed us. As I said earlier, a lot of this is new terminology, and we're going to be spending several weeks on these terms and transactions and different ways that transactions get recorded. So if you are confused right now, do not be concerned, because nobody expects you to be an expert in the first week. It's going to take time, and we're going to be talking about this a lot.